So global equity markets endured a bit of a bear market bounce last month. They were up about 6.9% if you look at the FTSE All World Total Return Index, and that was predominantly led by a bit of a Fed dovish pivot according to sort of market expectations, and really a lot of the high beta sectors led the upturn that had previously sold off quite hard. And similarly, if you actually look at the global bond index, that was up about 2.2%. And quite similarly, with the Fed dovish pivot and also slowing demand dynamics, we saw global sovereign bond yields fall across the curve globally. So there were many idiosyncratic events that happened in July. Unfortunately, we saw the ex-Prime Minister of Japan was assassinated, Shinzo Abe, and moving forward to the Western world, we saw UK Prime Minister Boris Johnson resign. And on the energy front, there were a lot of occurrences around the world. So starting off in Sri Lanka, we saw quite a bit of uproar with regards to inflation being untenably high and the country grappling actually to pay for basic necessities. If we move over to the Netherlands part of the world, we saw Dutch farmers protest amid a 50% reduction in ammonia and nitrogen emissions by 50% for the year 2030. So that is going to be a bit of an issue in terms of maintaining profitability there. And taking a look in Germany, we also saw the fact that Uniper, their main energy supplier, actually require government assistance so that they can make sure that they are profitable and can have enough working capital in terms of making sure that there's enough energy supply to the region. And in fact, if we look at the broader European region, we saw commitments from countries to reduce 15% of Russian imports so that when they head into the winter stages, that there's actually going to be enough for total energy security going forward. So the latest 75 basis point hike by the Fed was largely priced in by the market and expected by us, especially given the fact that we saw inflation come in at the highest print since November 1981 at about 9.1% in June. And in fact, it comes at quite a fragile time in the economic cycle, shortly after the US confirmed that it's in a technical recession, recording 2 negative quarters of economic growth in the first and second quarter of the year. If we look over at the ECB, we saw they also delivered a surprise 50 basis point hike, really to tame the levels of inflation that we all know too well of around the world. And that also comes at quite a fragile time when confidence levels and economic data is quite depressed. So looking over at the ECB, they also delivered a surprise 50 basis point hike. And that comes at a time also when the economy is highly fragile, where data is recording new lows and when confidence levels are trundling at depressed levels. Market perceptions are really shifting from stagflationary type concerns to recessionary type fears. And that's really evidenced by the downturn in global sovereign bond yields that we've seen around the world. Nevertheless, we did see a bit of an uptick in the Bloomberg Commodity Index. That was up 4.3% over the month. However, in the previous month, it was down roughly about 10.8%. One thing that really caught our attention, though, is when the Federal Reserve announced their 75 basis point hike, they did say that it would become more data dependent, and we believe that market perceptions of that were highly dovish. So what we are concerned about is the jump in break-even inflation rates towards the end of the month. And if that becomes a bit of a concern for the Federal Reserve, where inflation expectations become unanchored, we have no doubt that they will tighten monetary policy even further to quell demand dynamics to make sure that inflation expectations remain well anchored and closer to their 2% target. So what we saw during the course of the month is that the dollar has truly acted as a safe haven asset. So despite low interest rates around the world, liquidity is being withdrawn from the market. And in fact, even during the mid-month, we saw dollar-euro hit parity and even below parity. So that is something that we believe is important in terms of an asset allocation perspective, to really hold some cash on the sidelines, particularly dollar cash, in this type of environment when demand is slowing and liquidity dynamics are being withdrawn. In China, despite economic data showing signs of an improvement, partial lockdowns were erected once again. Similarly, the tech funds became more of an issue with Alibaba, Tencent, and familiar names recording fines, and investor sentiment was certainly dampened by housing market fears in terms of non-payment and real estate developers not committing in terms of finishing their projects. So this has become an issue in China in terms of the real estate market. So that creates a lot of uncertainty in terms of the investment case in China. However, we will point out some positives. So some of the positives in China are they have very low inflation compared to the rest of the world. Their credit impulse has now turned positive, in fact, since the first time since March 2021. And also we have a lot of stimulus being taking place, both in the form of monetary and fiscal, in terms of some subsidies being erected to support the economy. And from a monetary perspective, we're seeing lower cost of credit. We've seen the reserve requirement ratio being cut. And ultimately, we've seen the cost of credit come down to initiate more credit demand in the economy. In volatile markets, it really does pay to have a global diversified portfolio, really to be well invested in different types of asset classes, equities, fixed income, and cash, to be a shock absorber in times of economic turmoil. But we will say that volatile markets can potentially create opportunity, but in these times, having a diversified portfolio can serve you well.